so let's let's keep going here. All right, so we got some different tax strategies. One of the biggest tax strategies for anybody is you hold on to your stock for longer than a year. Keeping it for less than a year, you're going to pay capital gains. If you hold it for longer than a year, you're going to be taxed at preferential rates. Therefore, it's going to help you. And if you have what's called loss harvesting, that's what I was talking about earlier, where you actually sell stock at a loss to offset your gains. Having losses on your tax return of up to $3,000 reduces your taxable income by $3,000. It reduces your adjusted gross income, which reduces your taxable income. So, and you have to balance it with other tax factors. If you think about the stock market in 2008, what happened? Yeah, it went way down, right? So a lot of people had a lot of losses. Did it make sense to sell a lot of stock? No. So at that time, there weren't a lot of people selling a lot of stock at a gain, but a lot of people still sold their stock. So there was a lot of people that kind of panicked, sold stock, had losses, and are still rolling losses forward that are offsetting gains. So those people that sold that stock got money out, technically had a loss, and they're still rolling forward losses from 2008. You can roll forward losses for a long time. So that kind of thing happens, and now those losses are offsetting gains. But are those gains are offsetting better than the losses that they took back in 2008, 9? Okay, just depends on what they sold, right? They ended up selling, GE, then yeah, GM, then yeah, because GM went away, right? Ford, on the other hand, sunk down and came back up. So it just depends on what stock you sold. Okay, so we have a couple different type of investment expenses. We've seen them both when we've done our forms already. We have investment expense and we have investment interest expense. And you need to make sure you keep them separated because they're not the same thing. Investment expense is expenses incurred to invest your money, right? It can go on your itemized deductions. It's a miscellaneous deduction that's subject to the 2% that's at the bottom as itemized deductions. It's deductible only when it exceeds that 2%. It's deducted in the year that you have it or you lose it. So that's the cost or money you spend to do investments, right? Interest is expenses on the loans used to acquire the investments. So money that you borrow to go out and make those investments, the interest you have on those. It's interest expense as an itemized deduction. It's up higher where you have your mortgage interest. There's another line for interest expense up there. It's deducted limited to the taxpayer's net investment income for the year. So you cannot deduct it more than your income. All right. It's investment is gross investment income reduced by the investment expense, and you can carry that over indefinitely. Now, neither one are that common for the typical tax return that you're going to see. Because investment expense happens, you will incur it, people will incur it when they're having investments. Thing is, it's not going to exceed 2% of your AGI. Now, I'm saying that for the typical tax return you're going to see, assuming you're doing typical tax returns out in the St. Louis area. Now, if you start working for a big public accounting firm, Reuben Brown, you're going to see tax returns where they have investment expense if you're doing the higher level tax returns. But for the typical, you're going to do your family, you're going to work at H&R Block, that's not a very common. Also, investment interest expense, same thing, because it's interest on the loans you took to make investments. It's not interest on loans. It's not interest on your house. It's not interest on your car. It's interest on loans you took to make investments. So you got to make sure you keep that clear. Okay, the next thing we're going to talk about is what's called passive loss investments. So passive losses are different because passive losses can only be offset against other passive losses. Passive losses are when you are in an investment in which you are not, it's not an active investment. So, for example, a lot of times when you're in real estate, you're not actively involved, you're passively involved. Rental property. So, a partnership, an S corp, rental real estate, those are a lot of time passive investments, right? Ordinary income from these are taxable as they're earned, like most income. It's taxable when you earned it. Ordinary losses may only be deducted if you're able to come what's called at-risk limitations, tax basis, and passive loss limitations. So only deducted if you can deduct them against other passive losses. Losses cannot exceed what's called your tax basis. We're going to talk about what that is. But for example, if you invest $20,000, you can only deduct losses up to $20,000. You cannot deduct more than what you've put in to that company. The losses can be carried forward, so if you end up putting more in, they can be deducted. You can increase your basis by putting more cash into the company. You can increase it by what's called share a debt, meaning as the company takes on more debt, even if your basis has gone down to zero because of losses, if you're still an active partner, your share of debt could go up, so therefore your basis will go up. And then share of undistributed income, meaning the company actually made income now, but they didn't give it to you, then your basis goes up. How you decrease your basis is losses and then when you distribute cash. So when the company distributes income to you, your basis could go down. So what's an at-risk limitation? All right, at-risk, our losses cannot exceed your at-risk activity. At-risk is what you put into the company. So think about, if you want to kind of compare it to not a passive activity, think about how much money you have in a stock. If you own stock right now, think about how much money you have in that stock. So how much are you at risk to lose?
All of that money.
That amount of money. Can you lose more than that amount of money? No. You can lose the amount of money you have in that stock. That's it. That's what at risk is. You can lose no more. But if you're a partner in a firm or a partner in a company without at-risk limitations, could you lose more? Yes. In a company where you're not protected, and they talk about sole proprietorships. Sole proprietorships, if the company doesn't have the funds and you're not protected, they can come after your house, they can come after your 401k, they can come after your kid's college fund, anything that your name is tagged to, they can come after. So at-risk limitations is you can only come after what you're at risk to lose. And that's why a lot of people like to invest in something like the stock market, is you're only going to lose what you put in. And so being a corporation, I can only lose what I have in AT&T. I can't lose any more, right? I own a piece of AT&T, but they can't take my house, right? They can only take my stock. All right, excess losses can be forward until the event occurs to create additional amount of at risk. So you can create more at risk by putting more money in. All right, it's calculated like a tax basis. It may not include the investor's share of debt if we have to repay it. It does usually include the mortgage debt, though. All right, so here's an example. Lon purchased an interest in a limited liability company for $50,000. And the LLC has no debt. The share of the loss for the current year is $70,000. How much of the loss is limited by his tax basis? The other question is, how much of the loss is limited by his at-risk amount? So what is the first question, sorry, how much of the loss is limited by his tax basis?
70.
Okay, $70,000 is limited by the tax basis, leaving how much of the loss? $50,000, right? That's how much you can lose. So how much of the loss is limited by the at-risk amount? $50,000. So the tax basis is $50,000, consisting of his $50,000 investment. As a result, $20,000 of his $70,000 loss is limited by his basis. So he is limited by that $20,000 is limited. His at-risk amount is also $50,000 because they don't have any debt. All right, so we have a couple other passive activity limitations. So that passive activity limitations are applied after the tax basis and at-risk limitations. Losses from passive activities may only be deducted or to the extent that the taxpayer has other passive activities. Passive activities can only be offset against other passive activities. You cannot offset it against capital gains. You cannot offset it against other business income. It can only be offset against other passive activities or when a passive activity is sold. So they're conducive to itself. Passive activity in trade or business or rental activity is when we don't materially participate, meaning you're not an active participant. And we're going to talk about what those rules are. So participants in real estate and limited partners are generally considered passive. Why is rental real estate considered passive? I don't know. I think usually because it's considered kind of a hands-off, not actively. You're not a real estate agent. That's not what we're talking about. Rental real estate, where you're like renting your house or doing something like that. So that's usually considered passive. All other participants are considered passive unless they have a regular, continuous, active role in the business. All right, that's the rule. There are 7 factors in what we call material participation. Now, these can get a little confusing. One of the things you just want to keep in material participation is how much are you doing it? How active are you? One of the rules is individuals participate in more than 500 hours during the year. Now, does anybody know how many hours there are in an active year in which somebody is working? If you're working 40 hours a week, how many hours do you work in a year? 2080. Okay. How do you know that? Do you do internship or anything for public accounting yet? Okay. Usually you don't know that till you work for public accounting. There's 2,080 hours, all right, in a 40-hour work week. If you up that up to some 60-hour work weeks, you get to 2,400 pretty easily. So in public accounting, 2,080 hours is a 40-hour work week year-round. You're expected to work pretty easily 2,400, without a doubt, in public accounting. So 500 hours a year is working a quarter of the year. So materially participating is working a quarter of the year in whatever the business is. All right? The individual actively can constitute substantially all of the participation in such activities as individuals, including non-owners. So you're actively participating with those owners. The individual participates more than 100 hours during the year, and the individual participation is not less than anybody else. So, okay, so we just got rid of the 500 hours as long as I'm more than 100 and I'm doing as much as everybody else is doing. So basically we're saying the company is pretty small. We don't do a lot throughout the year, but I do as much as everybody else and it's over 100 hours. All right. And think about 100 hours. That's what, 2.5 weeks? So that's not a lot. All right, the activity qualifies as a significant participation activity. All right, more than 100 hours spent during the year, and all the aggregate significant participation activities is greater than 500 hours for the year. So that means everybody in the company hours are greater than 500 total. So me, you, and you, we're all greater than 500, but mine is greater than 100. And then we got individual participates in activity for any 5 of the last 10 years. So now we're saying I don't even have to do anything this year if I did it 5 out of the last 10. We participate in any 3 preceding years in any personal service activity. So this one is law, accounting, architecture, health. And then take into account all the facts and circumstances, the individual participates in a regular, continuous manner. So when it comes down to it, it comes down to the question of, do you feel like you actively participate in that business? If you think you do, then the answer is yes. If you say yes, you are being taxed at a higher rate versus a lower, so you're not going to go wrong. If you say no, you want to make sure the answer is actually no. So that's when you want to come back to these 7 tests and make sure your answer should really be no. Because if you look at it, there's not a lot of ways to be no. All right? But it just depends on what you're doing. I have friends that work for like Mary Kay or, what is it, Avocare and all these little health things that, you can sell. Are they active? Well, it depends. I have some that are. You go on their Facebook page, they're selling the stuff, that is active. I have others that you're like, if you want something, let me know, I'm selling it for myself. Okay, they're not active. They buy it so that they pay the yearly fee so they get the discount. They're not actively selling. So therefore, they would not be active participants. But the people out there saying, hey, buy this, it's on Facebook, let me know, that's active. So you got to be able to tell the difference. Okay, so here's Lon, same person, sorry. He owns rental property that produced $5,000 of rental income. How much of Lon's remaining $50,000 loss can he deduct? So in addition to what he already had interest in that company, $70,000, remember they had a loss, he put in $50,000. He has a rental property that produced $5,000 of rental income. How much of his $50,000 loss can he deduct? Because remember, he had a $50,000 loss. How much of that $50,000 loss? And what happens to the portion, what happens to any portion, just gave you a hint, of that he can't deduct? My only hint is don't overthink it. Don't make it too hard. If he has a loss of $5,000 and he had income from rental property of $5,000, what did I say rental property was? Was it passive or active? It's passive. His other thing was also passive. So if we have a loss of $50,000 that was passive and a gain of $50,000 that was passive, we put those two together, we have one's a loss, one's a gain, $45,000 loss. All right, so we put those together, we have a $45,000 loss that remains passive. So we're able to deduct the $5,000 gain. We don't have to recognize that gain now. But we have $45,000 loss that we carry forward. We carry forward that loss until we have more passive gains. All right. So that's what happens with the passive activity loss. You can offset it against gains, but otherwise you just keep carrying it forward. You don't get to deduct it by itself. You only deduct it against gains. And at the end of the day, he can deduct that. He still has a $20,000 tax basis and is at risk carry forward and $45,000 of passive activity carry forward. But his basis is $20,000 in that property now of that business because he had that loss. Okay, how about this mom and pop? Okay, so they rent out their home to some students. They have new tenants. They need to make repairs. Their AGI before doing anything was $90,000. Their loss from the rental property is $16,000 because of all the repairs they made. If they have no other passive activity losses, how much of that loss from the rental home can they deduct? Now, we haven't talked about this yet. I'm just curious if you know. You're right. They can deduct the whole $16,000, right? Because we just switched to a mom and pop who are doing their own tax return, who are renting out a house that's going to show up on a Schedule E, that's going to flow to line. I just moved it over here. It's going to flow to line 17, right? Oh, here we go. Okay. And they can actually deduct up to $25,000 of rental loses. All right? You and I can deduct up to $25,000 in rental losses. All right. However, we phase that out once they start making over $100,000 up to $150,000. 50 cents for every grand over every dollar, over $100,000. So what's interesting about that is it benefits those that have the rental property under $100,000. I have friends that have a rental property that have been losing money. They bought it to flip it. Now this was, I want to say it's probably been 8 years since they bought it because they bought it before 2008. So they bought it to flip it back when buying to flip it was a good thing. And they bought it to flip it and they couldn't flip it. Right? So they have a house. So they start renting their house. And they were able to rent it right away, but then they had trouble renting it. Well, when you have trouble renting it, now you have a loss. And then you get a bad tenant. Guess what happens when you have a bad tenant? Damage, right? And it's not like it was in a bad area. They just got a bad tenant. And so they had damage, they had repairs, they had losses. Wouldn't be a horrible thing, except for they make too much money. So they suffered losses for 3 or 4 years in a row, and they didn't get to deduct any of the losses. So not only do they not have money coming in from the rental property, because they had to put in all the work and they weren't renting it out, they didn't get to deduct any of the damages because they made too much money. So it's a catch-22. You're saying, well, they make enough money, doesn't matter. Well, when you're renting out a property and you're expecting money coming in, it really doesn't matter how much money you make. You're expecting that money to come in to cover the expenses. All right. Oh, I just jumped that. Okay. So,